Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for September 26th of 2022. Please see our disclaimer for important information. Here's a survey of consumer price indices across different geographies. We've got the UK, which we know is exhibiting some increase in inflation right now, a lot of it due to energy. Germany for the same reasons, US and Japan. US is in the kind of the bolder blue, if you will, Germany in the lighter blue. And you can see that, in the US, we feel like we probably have peaked in inflation. You can see the trajectory as estimated by the OECD, which is the Organization for Economic Cooperation and Development. Here you see Japan never really exhibited a whole lot of inflation and expecting a flat line, but you can see the other geographies heading certainly into 2023, all falling at some point given decreases in demand. Here's a look at central bank interest rates. So we know that the central banks across the globe are raising rates for the most part. You've got some geographies that are not. Clearly, China maybe being an exception there, but not everybody is moving in tandem. Most of the developed world is. The U.S. just happens to be moving at a faster pace than some of the other geographies. Eurozone, given its wide geography and wide financial and economic footprint with varying areas of strength and weakness, are having much more difficulty raising their rates right now. Also considering the issues pertaining to the Ukrainian invasion and energy supplies, so on and so forth. And so you see the dollar moving much higher because of this strength. Here's PCE, Personal Consumption Expenditures Price Index. Again, just to kind of refresh our memory from some of the data that we've been looking at over the last several weeks. Both the PCE and the core PCE. Now these represent the kind of the key inflation measures that the Fed spends a lot of time looking at. Now they're not as high. They traditionally are not as high or as robust as the consumer price index or the CPI figure is, but they both trended in the same direction. You can see core is already moving a little bit lower, but it remains relatively high. Of course, the Federal Reserve's target there, and that dotted line is 2%. So we're well above that and continue to see that trending down as we saw in the OECD numbers throughout the balance of next year. Here's the leading economic index, LEI for the US, change from the prior month. We have actually been down in the LEI now for 6 straight months. And so that is generally very symptomatic of a ongoing economic downturn, which I do believe is actually underway. There are some areas of the economy that seem to be holding up pretty well, all things considered, but LEI is usually a pretty strong barometer for pending recession, pending economic downturn. I think this is kind of very, very consistent with what we've seen in prior downturns in this, sequential monthly data here. Here's a daily package volume for FedEx. Of course, FedEx was down quite a bit last week when it pre-announced, down over 20%, which is the largest decline that stock has ever seen. You can see the package volume going down, another pretty decent barometer of the economic backdrop. And actually, in response to this data here, FedEx has announced that they're going to be increasing prices by some 6% to help offset that. Here's existing home sales. We know that the market has been impacted because of affordability. Mortgage rates well over 6% now. We see homeowners really not being very interested in moving because I believe the figure is 3/4 of all mortgages right now are less than 4% So, why would you want to move just so you can take on a mortgage rate that's about 2.5 percentage points higher than that? So the mobility is waning right now, so that we'd expect existing home supply on the market to wane a little bit, and also demand for borrowers that are, the cost of a mortgage has gone up considerably in terms of its impact on your total net income. That's also changed considerably in a fairly short period of time. So as a result, you see existing home sales trailing off here for the time being. Here's an interesting chart, grocery prices. It gives you a snapshot on various things. I caught this in one of the newsletters in Wall Street Journal, and it was highlighting butter, but it gives you a sense of a lot of these other categories too. Milk up 17% year over year, roasted coffee up 19%, eggs up 40%, chicken, and it goes all the way down. And ironically, in areas where we haven't had necessarily a significant drought, beef prices aren't up that much, but they certainly are in areas here, like say in Texas, where we've had a drought and a lot of herds are being liquidated, and beef prices are a little bit higher than what it reflects here, this being kind of a national average. Product shortages and core goods CPI, something that we paid attention to on a fairly regular basis here. We've looked at goods inflation as having, gone up during in the pandemic and the shutdown. There's a lot of demand for goods that peaked earlier this year, rolled over. We can see the relationship here between core goods CPI, which is in that dark line, and the shortages indicator. So, when demand went up, CPI and the inflation rate for goods went higher, and that correlated really tightly with shortages. Now, we've seen those shortages abate, and this tells you that with the inflation rate rolling over, that those product shortages should really kind of go away at some point. Here's inflation without a recession. This is kind of like the sequential buildup. I thought this was pretty interesting. So obviously you've got slower growth, or what they're calling below potential GDP growth. Then it lowers the jobs to workers gap, meaning that right now you've got more availability out there for the number of unemployed workers that we have in the workforce. And once that job to workers gap narrows a little bit, then wage growth should slow down, and then that should help to bring down core inflation. Now, these aren't the only levers that affect inflation ultimately, but these are some of the more important ones. Now, wage growth is important because it's very sticky, and it tends to be very sticky until you have that change in the jobs to workers gap. So, as we watch this over the next year or so, and some of these dislocations in the labor market begin to kind of surface right now. We're not seeing it right now, but when we begin to see that manifest itself, then I think we can feel really good about the pace of inflation moving materially lower. Here's a forecast for payrolls talking about labor. This is from Bank of America Global Research, and it shows you here that the pace of non-farm payroll growth is slowing. Well, we know that in the data, so that's not a surprise to us. Now, this forecast shows us going into decline for jobs, and you see the unemployment rate by their estimation moving up. That's the U3 unemployment rate, and you can see that the unemployment rate by their estimation is going to move higher, about 3.6 to about 5% by this time next year, and then begin to trend back down as the labor market begins to improve. So they're really looking for about, say, about 6 to 8 months of decline in the actual payroll numbers, which would be consistent with kind of this recessionary environment that we're kind of anticipating next year. And then obviously conditions improving into 2024. Here's the National Federation of Independent Business, price plans and CPI inflation. So what we're seeing here is actually a pretty significant change from not too long ago, in fact. And so the NFIB is basically small businesses that plan to raise prices. This particular series here in this kind of light colored purplish line here is advanced 6 months to show you kind of as a leading indicator here that the price raising intentions have really gone down quite a bit in just a fairly short period of time. Again, it kind of indicates a decline in demand that they're seeing on end markets, and so as a result, the intentions are going down. And so with that, you can see the relationship as a leading indicator for core CPI inflation that we would expect to see core CPI follow along here in the months ahead. Here's import prices as a result of a strong dollar. Now, import, when you think about this, a strong dollar means that our exports tend to be very much more expensive than they would be otherwise, and our imports, because other currencies are weaker relative to the dollar, our imports are cheaper. And so import prices, we're essentially kind of importing disinflation. So you see import prices ex food and oil dropping, and then you see the CPI number in the black line. And so this should be another one of these leading indicators. As long as the dollar remains strong relative to other currencies, there's no reason to think that that won't be the case because the Fed has signaled its intention to be very aggressive with short-term interest rates. So with that in mind, we should see yet another, this is another indicator that should help to bring inflation down in the coming months. Here's a slide from BKA research that gives us a little bit of insight on the pace of global trade and perhaps what we should expect. Not too surprisingly, is a slowdown in global trade because the weakness in economic growth that we've seen in the U.S. here to some degree is mirrored around the world. We're seeing kind of a global contraction, if you will. And so this slide gives you an indication in the dotted line. It's imports for processing trade. These are items of intermediate production coming into the U.S. And if you have a drop in that, even though import prices are low, because we just talked about that with the strong dollar, imports are cheaper, but even especially so, if you have that environment and you have a drop in imports for processing, that should tell you that we're on the precipice of having a drop in export value as well. And so that dotted line is advanced here in this chart by 3 months. And so you can see that that should correlate pretty tightly to a drop in export value, which is very symptomatic and very consistent with global economic growth. And that this data is corroborated in other areas, shipping costs, Baltic Dry Index, all of these things are rolling over, container shipping costs and whatnot, they're all rolling over. And we see here that costs for industrial metals have gone down as well. And so instead of isolating iron or steel or scrap or perhaps copper even, this is kind of a sub-index of all of those, the industrial metals, and you can see that they're all coming down. We see construction intentions begin to curb a little bit, and as a result, we see these commodity prices come down a bit. Here's wheat, looking at wheat as just one indicator and one that's actually been in the news quite a bit for the entire year. You can see in February during the Ukrainian invasion that wheat prices went through the roof as Russia and Ukraine are big exporters of wheat to the global sphere, particularly into Europe, into some of the third world countries. But you can see prices having rolled over, and they've picked back up again a little bit. They're above where they were, certainly above that trend line heading out of the pandemic into 2021, but they're certainly nowhere near where they were earlier this year. Here's a quick look at the S&P 500 forward. PE is in the black, and you've got the 10-year real tips yield, or I should call it it's the 10-year tips yield, but it's the real rate of inflation. You can see that the relationship here is fairly strong, and what we've got now is a scenario certainly after last week with the sell-off, that we've got valuations that are much more attractive. We're down around 15 times, which is very consistent with the long-term average, and we also have an increase in the real rate. You can see that 10-year tips, that number on the right-hand margin, that is an inverted line, and so you can see that number is over 1.3. So we've got positive real rates moving higher. At the same time, we've got multiples moving lower in the face of inflation, getting us to a better environment overall for stocks to exhibit a little bit of strength in the months ahead. Our 10-year tips yield, that is the inverted line that you saw in that last chart. You can see that it's moving higher, about 1.3%. You can see that it was negative for most of the pandemic and into early part of this year, but this is actually a really good sign. This is certainly a better indicator of health within the financial markets when you have real yields moving in not only just into positive territory, but into solidly positive territory. Here's the S&P 500 and the relative strength indicator down below. And I think this is important because of the weakness that we've seen and the relative strength. The RSI that you see down below, and you see this little encircled purple areas, and that represents areas where we've broached this lower boundary, and a boundary which would typically be deemed as an oversold condition in the market. And we are absolutely there right now. And so, with the market having been weak, this isn't to say that we're going to start a new bull market or anything like that necessarily, but the market just is being oversold after the trouble and the tumult of last week. Here's a quick look at home prices. This is the Case-Shiller National Home Price Index. You can see that as we talked about housing affordability and the demand for housing, we saw that a little bit earlier. This chart shows us the pace that we've observed in the dark blue, and the light blue represents where we think the environment is going. This is from Standard & Poor's, and it's Goldman Sachs Global Investment Research, and they're looking for basically flat home prices heading into 2023. Here's a quick look at gasoline. Gasoline continues to move lower on balance, although it finally did break its consecutive streak. So we had a very slight uptick, but the general trend in gasoline prices is solidly down. Private housing units. This is something that I think we should all pay attention to, not only from a local standpoint, but from a national standpoint as well. We have a lot of private housing units, both single family and multifamily, that have been entitled and authorized. They just haven't been started yet. Now, builders are, that have control of the land on which these structures are being built do have some flexibility on when these things are constructed. And, it depends a lot on financing costs, availability of materials, availability of crews, labor costs, so on and so forth. And, and unless there's significant negative carry on the land that they're holding, waiting for this construction, they can hold on to it for a while. But what this shows you is that there is a considerable amount of housing units that have been drafted, authorized, entitled, zoned for, et cetera, et cetera. They just haven't been started yet. That's just a brief synopsis of a few slides that caught my interest over the last week. I hope you've enjoyed the slide pack this week. We'll be back next week with some additional insight, and hope you have a wonderful week, and we'll talk to you again soon. Bye.